fact, almost half of the trades on the New York Stock Exchange each day happen in a matter of milliseconds. It's called high-frequency trading, and it's a topic of debate in Washington right now. Does flash trading put small investors at a disadvantage? We're going to bring in Bloomberg's Eric Martin. He has been covering the issue. This is also the hot topic at the Bloomberg cafeteria. Everyone's really interested in high-frequency trading. Why is it getting so much attention now?
Everyone is always interested in who the winners and losers on Wall Street are. And if you talk to people who have observed the evolution of high-speed trading, high-frequency trading, people say it's like being at a poker game where the other players know your cards. It's like it's reading your every move for some of these people who feel like they're being victimized by the high-frequency trading. And it boils down to things as detailed as the speed of light in terms of the fiber optic cables, the co-location of some of these servers and this technology on the floor of the exchanges for some of the most lucrative and most profitable trading desks in the world. So this is something that there's a lot of suspicion that's been cast on it lately, and we've seen just a lot of attention. It's been around for the last several years, but a lot of attention being focused lately on, is this fair, or does this create an unlevel playing field?
And is it unfair because it's like a smaller trader versus a bigger trader, or is it unfair to the average investor?
It's unfair to the average investor, critics would say, because it makes it harder for them to have their trades executed in the way that a prop desk at a large investment bank would get the pricing. And so if it's disadvantaging the average investor, critics are saying, then does it discourage people from getting involved in Wall Street at a time when we've had scandals like Bernie Madoff, when there are already things to make people disillusioned with the capitalism and the trading systems that exist? Is high-frequency trading and a feeling of unfairness there just one more thing piling on for the average investor?
Now, lawmakers are crusading against this, certain ones like Senator Schumer. Why?
There's a powerful lobbying effort by some of the existing exchanges that are losing business to some of the other growing exchanges that are using high-speed trading and offering rebates to increase revenue and increase customer base. And so that's one thing that the NYSE has been vocal about, saying that high-speed trading, high-frequency trading creates an unfair advantage. But high-frequency traders would argue that they take the time and put the effort and money and research into making these race cars that run faster than the cars that are held by other brokerages. Why shouldn't they be able, if they're faster, to take advantage of that? Isn't this the evolution of Wall Street and finance?
And they argue that it makes the markets better.
Absolutely. They argue that because there are so many shares trading, it actually increases liquidity and the number of shares that are available for trading. The argument against that is that there's nothing requiring high-frequency traders to stay in the game. If for some reason they decided at some point to pack up their cards and leave, does this leave a huge void, taking away 50% of the trading on an average day in the U.S.?
It should be really interesting to see if the law actually takes a step to intervene into this. All right. Thank you so much for joining us and explaining that to us.